Hello and welcome to the Financial Times. Well, last week the Chinese shocked global markets by devaluing the Chinese renminbi, which had been appreciating along with the dollar for quite some time now. With me to discuss what this means is Henny Sender, our Chief International Financial Correspondent. Well, Henny, thank you so much for being here. This is very interesting stuff. I mean, people have been talking about the Chinese renminbi for a long time. People thought it was going to follow the dollar up, and then suddenly the Chinese decided they're going to cut it. Why do you think they did this?
I think it became too painful for them. As long as the dollar was going up, you know, it was more and more painful for the Chinese to sort of have this informal peg. And in the last 3 months, the renminbi went up 4% as people were assuming that the Fed would raise rates and the dollar gained. It's just too much pain. In retrospect, people shouldn't have been so surprised.
I guess it's a bit like the Swiss National Bank when they're depegged. It makes perfect sense in retrospect, but it still shocked people. And what kind of impact did it have? Was it really that earth-shattering?
You know, I think that people were too complacent for a long time, and the Chinese are in a transition. They are trying to move away from their template of export for manufactured goods, and it takes time though. And you know, they have a lot of reason to ease now, so they have joined this trend. And you know, as soon as the stock market came down and you saw reserve rate cuts, you saw interest rate cuts, it was only a matter of time really before the renminbi would follow, even if they hadn't, you know, intervened so aggressively to communicate this message. It's no longer just a one-way bet.
Yeah, and I guess one-way bets never last forever, do they? But how much of this is, you know, on one hand supporting economic growth in China, which has been slowing? It's hardly economic crisis, but definitely sort of approaching levels where the Chinese authorities might feel uncomfortable, and how much was it to get the renminbi become more freely floating, which is what the IMF and the US has ostensibly said they want in the past?
It was both. You know, the Chinese authorities have always said the markets are too focused on growth. What we care about is jobs. And when the job numbers slowly started turning down, that's when you saw them really saying, we have so much reason to put the renminbi on a more weakening trajectory. So it was to support jobs, support growth, and it was also because they clearly have aspirations for the renminbi to be a reserve currency, to be more market-driven, so it can be part of SDRs. And it's also all the loosening measures they're taking in an effort to underpin the stock market. Unsuccessfully, I might add, so far.
Yes, no, it's taken a bit of another tumble. But how much, I mean, is this the start? I mean, the People's Bank of China, the Chinese central bank, has said that, you know, people should start panicking. You know, they've actually let the currency appreciate a few days now as well. But is this the start of a steeper devaluation? Do you think they'll let it slide further down into the next year, maybe?
I think there are a lot of constraints. If you look at the last year, you've seen outflows of 350 billion. Much of that was to hedge the currency. At the same time, you have a lot of dollar debt in China. So they have good reasons not to let the currency go too far down. And their long-term goal is about forcing their companies up the more value-added chain and helping the economy move to a more service-oriented, domestically driven economy. So my base case for China is soft landing in China, much harder landing for its counterparties.
Yes, it's been very painful for emerging markets. I mean, how do you think the other countries around China feel about this, like Japan and South Korea, Taiwan, so on?
You know, I think that all the countries in Asia outside Japan are very concerned with the depreciation of the yen driven by its own quantitative easing policies. And because you've seen second quarter numbers being very bad in Japan, people expect a whole nother round of easing from the Japanese, which will infuriate their neighbors. So you have the prospect not of competitive devaluations, but competitive QE, which will indirectly drive its competitors down. You know, in the world today, where world growth is much softer and world trade is essentially flat, you know, it really has become a zero-sum game. And I think most of the ire of Asia is more directed against Japan than China.
Well, understandably, looking at the scale, the different scales of devaluation. But finally, one of the other countries that's also always concerned itself a lot with Chinese currency policies is the US. So there's been so much talk over the years that China's had an artificially suppressed its currency to help its exports. Now that, you know, China had started letting their renminbi appreciate, now has cut it. Do you think this is something that the US is going to start complaining about again?
I really hope it doesn't do that, because it infuriates the Chinese. It's very counterproductive. And you know, the yen has depreciated 50% against the renminbi. Even the IMF, you know, says the Chinese renminbi is not overvalued anymore. My own belief is the US will have a much harder time if the renminbi continues to appreciate, because Chinese companies have a very formidable outward bound investment program, and they can afford to buy a hell of a lot of resource companies all over the whole world. And in the long run, they'll become more competitive as a result.
So it's either buying US treasuries if the currency depreciates more, or buying US companies.
US companies and companies all over the world. And because China is dependent on resources from abroad, you know, the cheaper those resources are in renminbi terms, the more competitive China becomes.
Yeah. Well, Henny, thank you so much for being here.
My pleasure.
The developing world's stocks, bonds and currencies have just been on the receiving end of a haymaker from China in the form of its modest but ominous devaluation.